How businesses manage money. The foundation of any successful company is sound financial management. Understanding how to manage finances can mean the difference between success and failure, regardless of how big or little your company is. To be competitive and sustainable, organizations must manage their resources wisely, from balancing cash flow to making smart investments. The difficulty is in making sure that funds are not just handled prudently, but also to support expansion and shield the company from unanticipated dangers. We'll look at the 7 main methods that companies employ to handle their finances in this tutorial. By guiding people through the challenges of risk, investment, and budgeting, these strategies guarantee long-term success and profitability. Entrepreneurs and company executives can use the financial management techniques of successful companies to establish a strong financial base for their own businesses. Let's examine how companies efficiently handle their finances. 1. Management of cash flow. For every organization to function efficiently and without financial interruptions, effective cash flow management is essential. It entails keeping enough cash on hand to pay for regular costs while also making space for potential future investments. In order to balance incoming and leaving funds and prevent shortages, businesses usually predict cash flow by projecting revenue and expenses over a given time period. Businesses frequently utilize cash flow estimates and statements to track their cash flow, which gives them a better understanding of their financial situation. Effective management enables them to plan for times of reduced income and foresee certain obstacles, such as seasonal downturns or unforeseen expenses. To close short-term gaps between revenue and expenses, some companies may use credit lines or revolving credit. Businesses often keep an eye on timing in addition to cash flow. The secret to a more seamless cash flow is modifying the conditions of payment with clients and suppliers. Businesses can prevent liquidity problems and maintain operations by negotiating longer payment terms with suppliers and asking clients to pay more quickly. 2. Financial forecasting and budgeting. Another essential component of firm financial management is budgeting. A well-crafted budget aids businesses in allocating money to different divisions, initiatives, and costs. Budgeting guarantees that resources are allocated effectively to achieve company objectives, whether they are related to marketing, product development, or staff remuneration. By projecting future revenue, costs, and expenses based on historical data, market conditions, and present trends, financial forecasting goes one step further. It enables companies to foresee their financial requirements and modify their plans appropriately. Businesses can find areas where they might be overspending or underperforming and take corrective action by comparing actual financial performance with projected numbers. To make sure that a company's expenditures are in line with its overarching strategic goals, regular budget reviews are crucial. As business conditions change, for example, demand changes, the introduction of new products or economic downturns, budget adjustments can be required. Businesses can prevent costly overspending and stay on track with their financial goals by actively monitoring the budget. 3. Handling debt. Although borrowing money can be a vital tool for expanding a firm, long-term financial stability depends on effective debt management. Businesses frequently take out loans to pay for operating expenses, buy inventory, or fund new initiatives. Businesses must, however, strike a balance between their debt load and their capacity to pay it back. Financial strain brought on by a large debt load might make it more difficult for firms to meet repayment deadlines or service interest payments. As a result, managing debt entails carefully selecting the credit lines and loan kinds that best fit a business's financial circumstances. Short-term loans, for instance, can be used to manage working capital, But long-term loans are usually more appropriate for major capital expenditures like real estate or machinery. Companies also evaluate their financial leverage using a concept known as the debt-to-equity ratio. A greater debt-to-equity ratio suggests that a business is using debt to fund a sizable amount of its operations. This raises risk, even as it may raise possible profits on equity. 4. Strategy for investing. Businesses can also manage their finances and make money by investing. Many businesses invest their earnings in a range of assets, from bonds and equities to real estate and emerging technology. By diversifying a company's revenue streams, a sound investment strategy can lessen dependency on a single source of income. Business investments, however, necessitate thorough preparation and analysis. Businesses must, for instance, evaluate the risk of each investment and make sure that it fits with their overall objectives and financial capabilities. While a company that makes too cautious investments may lose out on lucrative opportunities, one that makes too many investments in high-risk assets may endanger its stability. Many companies decide to reinvest their revenues in order to grow over the long term. This can be done by expanding operations, purchasing other companies, or investing in research and development. 5. Tax optimization and planning. For firms, tax administration is an essential part of money management. Businesses can keep more of their profits and reinvest them in the business by reducing their tax obligations. To lawfully lower tax loads, effective tax planning entails knowing and utilizing tax laws, credits, deductions, and other tactics. To assist in navigating the intricacies of tax legislation, many organizations employ accountants or tax specialists with expertise in corporate taxation. These professionals are able to spot tax deduction potential for things like R&D costs, employee benefits, and business travel. To lower their taxable income, several businesses also use tax-deferred retirement plans, such pensions or 401(k)s. In order to avoid penalties, businesses must also make sure they adhere to regulations and be aware of tax deadlines. 6. Insurance and risk management. Protecting the company's assets is just as important to money management as keeping income and expenses under control. Risks that businesses must deal with include market instability, employee injury, property damage, and cybersecurity attacks. Companies frequently invest in insurance policies and put risk management techniques into place to protect against these hazards. Depending on the nature of their operations, businesses may require any of the many different types of insurance. These consist of property insurance, workers' compensation insurance, general liability insurance, and product liability insurance. 7. Cost control and profitability monitoring. Any business's ultimate goal is to maintain profitability. Companies must keep a close eye on their financial performance to make sure that revenue surpasses expenses in order to accomplish this. In order to determine whether the company is on track, profitability monitoring entails tracking key performance indicators, KPIs, such as profit margins, gross sales, and net income. Cost control is one of the most important components of profitability. In conclusion, one of the most crucial elements of operating a profitable business is efficient money management. Businesses must use a variety of measures, from investment plans to cash flow management, to preserve their financial stability and expansion. Businesses may build a strong financial framework that supports both short-term operations and long-term objectives by carefully planning their budgets. Let us know in the comments what you think about how businesses manage money. And don't forget to like, subscribe, and stay tuned for more captivating content on our YouTube channel.